Hi everyone. Let's take a look at problem 5-1A, which deals with some journal entries relating to a merchandising business. We're asked to prepare journal entries to record the following merchandise transactions of Blink Company, and they use a perpetual inventory system. Okay, let's tackle the July 1st entry. Now, in this demonstration, to save time, rather than typing them in, I will just reveal the solutions one at a time. And I think you will get the exact same effect as if I was working them in Excel before your eyes. Okay, so on July 1st, Blink purchased merchandise from the Bowden Company for $6,000 under credit terms of 115 to N30. So I'm reading the first transaction just to the left of my mouse here. And what else do we know? 115 net 30 FOB shipping point with an invoice dated July 1st. Okay, so what we need to do is record that purchase. All right, let me slide this down. You should be able to reveal what we would do. So on July 1st, we would debit. Move this down a little bit, and now slide off. We would debit merchandise inventory. Remember, this is a perpetual inventory system, so we hit the merchandise inventory account with an increase of $6,000. And we would credit accounts payable to Bowden. And the note we would write would say we purchased goods on credit 115 net 30. Okay, on July 2nd, we sold merchandise to Creek Company for $900, 210 net 60 FOB shipping point, invoice dated July 2nd, and the merchandise cost $500. We'll slide that one down a little bit, and we see that we would have a debit to accounts receivable to Creek, showing what is owed to us at the time that legal transfer took place and the sale occurred, and we credit to sales. But I think we have more entries involved on this one. Let me slide up a little bit so you can see it. Okay, so now we'll pay attention to the second half of this entry, where we have to record the cost of goods sold, and they tell us the cost was $500. So we debit cost of goods sold and remove it from inventory with a credit. Okay, let's take a look at July 3rd. We paid $125 cash for freight charges on the purchases of July 1st. Okay, let me slide this down. And we're going to run out of room here, so I'm going to slide the whole thing up again. Okay, slide this down a little bit, reveal what happens on the 8th and the 3rd. Okay. First, we'll tackle the entry on the 3rd. We paid the freight on incoming goods. Now, freight is considered a component cost of inventory. So sometimes this is called freight in. The cost of freight related to merchandise you purchase gets included in the cost of inventory. And that's why we debit inventory for $125 when we are aware of the freight charge. Now, on the 8th, we sell merchandise for $1,300 for $1,700 in cash. And just like the entry before, we're going to have two entries with a perpetual inventory system. Okay, we're going to have the entry where we receive the cash of $1,700 and we record the sale, but then we have to make the entry relieving inventory of $1,300 and debiting cost of goods sold. And so what you're seeing is a little bit evidence of the matching principle. We are matching the sales, that credit of $1,700, with the cost of sales at the time the entry takes place. Okay, slide this down. We'll take a look at what happens on the 9th. We purchased merchandise from, looks like Light Company for $2,200, 215 N60 FOB destination, dated invoice 9th. Well, let's see if that makes a difference. Okay, so on the 9th, we purchased merchandise 215 net 60, so we debit merchandise inventory and we show the accounts payable of $2,200. We record the purchase of that goods on credit. Now, the fact that it's FOB destination simply means legal title won't transfer until it actually reaches the destination. But since we made the entry on the 9th and we're at mid-month, we're in the mid-month, not at the end of the month, I think the entry as it stands is the correct way to do it. Now on the 11th, we received a $200 credit memo from the company for the return of part of the merchandise purchased on the 9th. Okay, so to record that, we just simply need to show that we're not going to pay the $2,200, so we reduce accounts payable by $200, and we reverse the entry, and we credit merchandise inventory by the $200 that we returned to Leet or Light Company. All right, what happens on the 12th? We receive the balance due from Creek Company for the invoice dated July 2nd, net of discount. Okay, let me slide up again, give us some room here. And I think on the 12th, we're only going to see one half of that entry. Because there is the cost side already took place. I don't want to say one half of that entry. The receipt of cash only requires one entry. It's not like when you have a sale with the perpetual inventory system where you have to record the sale and then record the cost of goods sold. You only need to record the receipt of the cash, the reduction of the accounts receivable, and then you need to record that 2% discount that they took. Okay, so on the 12th, when it says net of discount, that means he's eligible for the discount, so we take 900 times 2%, we get $18. So we reduce the amount of the cash proceeds and we debit an account called sales discounts, which is a contra sales account. Sales discounts is a deduction from gross sales that derives at net sales. Okay, let's look at the 16th. We paid the balance due to Bowden Company within the discount period. Okay, let me slide that down, and what we should see here, which we do see here, is that we're taking advantage of the discount. So instead of paying them the full $6,000 amount that we set up as our obligation, we reduce the full $6,000 obligation by debiting accounts payable, but we're taking a 1% discount. So $6,000 times 1% is $60. We show that as a reduction in the merchandise inventory that we purchased, right? And we show the cash balance of $5,940 is what we need to spend to our vendor for the goods we purchased. All right, on the 19th, we sold merchandise that cost $800 to Art Company for $1,200 under credit terms of $215 and net 60 FOB shipping point invoiced dated July 19th. All right, let's slide again so we've got some room. Okay, so here on the 19th, we show the sale. We show the sale of the $800 for $1,200. Right? It cost us $800, so we record the debit to accounts receivable, the credit to sales, and then we need to record the cost of sales for $800 and the reduction in merchandise inventory of $800. Okay, so the second entry transfers the cost from the balance sheet, that's why it's credited, to the income statement. Okay, on the 21st, we issue a $200 credit to Art Company for an allowance on the goods sold. Okay, so now we need to give them an allowance. So I think what you're going to see, and you will see, is that accounts receivable gets reduced by the amount of that allowance, and we debit an account called sales returns and allowances. And sales returns and allowances also get reduced from gross sales to derive net sales. Well, by the way, in an earlier comment, I indicated that sales discounts get reduced from gross sales to derive net sales. That isn't always the case. Some organizations treat a sales discount as a financing cost, so it may appear in selling general and actually in general and administrative expenses or in selling expenses. I've seen it handled both ways. All right, let's move on down to the 24th. We paid Leet or Light Company the balance due after deducting the discount. So again, what we're going to see here. Let me see if I can find it. Okay, I found it now, so now let's reveal it a little bit. Okay, so on a little bit more so we can see the description. So on the 24th, we see the payment, which is net of the 2% discount. So we were paying for $2,000. We took a 2% discount. That's $40. So the net amount of cash that gets credited is $19.60. On the 30th, we received the balance due from our company net of a discount. Again, we're going to see the same kind of approach. We're going. Let me see if I can get this to show there. We show that we're not going to receive the full $1,000 because there's a 2% discount that Art took. Now, what you see is that accounts receivable will still be credited for the full amount, right? We have to show that the full amount did go away and is no longer an asset on our books, but we'll show the sales discounts of 2% debited, and then that's how the balance stays in balance, and the net amount of cash of $980 is given to us, but yet it clears the accounts receivable for the full amount. Okay, then our final entry on the 31st, we sold merchandise that cost $4,800 to Creek Company for $7,000, and invoiced dated July 31st, and this is FOB shipping point. So at the time of the sale, we believe it takes place on the 31st, right? The invoice is dated the 31st. Since it's shipping point, it's a legal sale on that day, so I think we're going to record that. And we're going to see two parts of that again. We're going to see both the sales portion, which is a debit to accounts receivable. Now we say dash Creek so we know who it was made to. The accounting information system would track that for you. And we credit sales, so there we've recorded the sale, and then the final entry, of course, is the debit to cost of goods sold, which is what we use when we use a perpetual inventory system, and a credit to merchandise inventory, which again removes the cost from the balance sheet and transfers the cost of the sale to the income statement, and that cost of the sale then is matched along with the sales amount, so that you see a slight evidence, if you will, of the matching principle in practice when we're using the perpetual inventory system. Okay, and that is this problem. Thanks, everyone.